This is the kind of change that we haven't experienced in our lifetimes. And it feels, and conceptually, it seems way too big to actually happen. If you're just sitting there looking at markets, you run the risk of getting run over if you're not seeing this bigger picture behind you. The US Treasury essentially incentivized every central bank in the world to find an alternative to holding their money in the dollar system. You got rich. And if things have changed, how do you stay rich? How do you hang on to that and not let the markets take it away from you? You can say markets are all-time highs, therefore buy the dip is still working. And there is a lot of truth in that. But it's becoming a lot scarier. This idea there's no hope for optimism, there's no opportunity for optimism, I think is massively misplaced. It's just, it's dark now, but it's darkest before the dawn.
You're watching Excess Returns. I'm Matt Zeigler, back on the show this week. Our good friend Grant Williams. How are you, Grant?
Matt, it's always a pleasure. I really look forward to every chance I get to chat with you because I never know what we're going to talk about, and it's always great fun. So thanks for having me back on. I really appreciate it.
It's a true pleasure. You don't get any ridiculous intro this time because, this
Good.
is the...
Thank God for that.
No, we're going to limit some of the nonsense, but only because I've got lots of questions to ask you about. I want to start here. This idea, I just can't shake from you. And it's this idea of the 100-year pivot. And it's a big friggin' word. What is the 100-year pivot?
I've been trying to define it for a while now. This is a project that Dimitri Kofinas and I have undertaken together. And it really sprung out of nowhere. It sprung out of feelings and a sense of something happening and something shifting. And Dimitri and I have been talking about doing something together for a long, long time. And back in February, I published a letter, which was a compendium of 5 essays. I got some good friends of mine, a mutual friend, Roger Mitchell, and 4 other guys to pen essays. And I gave them a very broad brief. I just said, look, I'd had conversations with all of them about the fact that they felt the world was changing. And I asked them to just put those thoughts into some kind of essay in any way, coming from any direction they wanted to. And I deliberately kept it broad. And I thought, if they all write about the same thing, there's information in there, so I don't really mind. But as it turned out, they all came at it from different angles. And each of those essays was stupendous in its own right. I mean, they really did a brilliant job, all 5 of them, but they're very, very different. And the compendium of different thoughts about how the world is changing and why was fascinating to me. And the only thread that ran through all of them was this idea of the fourth turning, this big cycle change. And so, Dimitri and I got to talking about that, and we've talked about his concept of financial nihilism a lot over the last 4 or 5 years since he kind of coined that phrase. And we both felt that this was something that we should try and explore, and without any kind of goal or without any set journey to go on, but this feeling of change, what's happening and how do we quantify and what's changing. And so those 5 essays, Roger came at it from a religious angle. Tony Deaton went back to kind of principles. Stephen Wilkinson talked about AI and how it might lead to the end of the nation state as a concept. Andrew McDermott talked about Japan and how Japan is different and how Japan has kind of gone through changes of its own. Simon Mikhailovich talked about the fact that the rules of the game have changed, and I think the title was "You're not in the billiard room anymore." And so within the confines of a table there are rules, but we don't have those rules anymore. So it was just a fascinating exercise. And so we've started this journey, Dimitri and I, and we've spoken to Neil Howe because the fourth turning was something that started this. We spoke to Russell Napier, we spoke to Charles Calomiris, and we just recorded a conversation with Eddie Chancellor, and we spoke to Pippa Malmgren. And each one of those conversations has been incredibly interesting and completely different. I mean, there really is no thread running through these conversations other than changes afoot and what is the nature of that change. And of course, everyone feels it, but they see it differently and it affects them differently. So it's a fascinating project, and I'm really enjoying these conversations.
I think the richness and the nuance of the project is part of what, not surprised that you and Dimitri are working on this together, but it's the richness and the level of detail in so many different categories. Because it feels like there's not a singular theme running through these, but they all feel very related. How do you even start to reconcile that in your head?
Well, I think that's it. I think you've hit the nail upon the head. I think for different people, the change feels different, and different parts of it affect different people in different ways. But the common thread is change. People feel like the world is different, and for a lot of them, it's negative. I'm currently in the UK, and there's a lot of negative talk about losing Britain, and Britain's not what it was, and there's a lot of problem with the migration coming in from Europe, and there's a lot of problem with the politicians and all this stuff. But it's, if you boil it down, it's that we're losing Britain, the Britain that the English and the Scottish and the Welsh and the Irish have come to know is changing, and obviously it's not all for the worse. But change is difficult, and people don't like it. And the older you are, the harder it gets. And so the nature of that change here is very different to the nature of change in Silicon Valley, for example, where it's hugely positive and they're upbeat about everything because they're all making a fortune out of it. But again, it's disruptive change. Roger and I had spoken at length about religion. Roger's a man of faith, as is Sir Stephen. Both great friends of mine. I don't claim to be a man of faith, but even I felt this shift in energy that had me questioning an awful lot of things. And both Stephen and Roger are both kind of beckoning me into the fold, and I'm pushing back at the moment. We'll see how long that lasts. But it's just been interesting to see this sense of things are different. I don't quite know what it is. It's unsettling. I'm trying to put my finger on why, and you find one piece that you can identify and say, okay, that's different. And you start from there. You start unpicking it, and it takes you in all kinds of directions if you're genuinely curious into what's trying to understand that change.
How do you think about it generationally in the layers? Because change represents what we want to hold on to, what we want to let go of, and also what the opportunity is. Because even in the Silicon Valley point, there was an age divide. There was a certain younger demographic that seized a change with technology and culture and opportunity all at once and made a lot of money doing it. That's not always the case. How do you think about this generationally?
Well, I think a big part of it for the kind of elder generations is perhaps superfluous. It's this feeling that we want to leave our kids the same world we had. And of course, that's never going to happen. No one inherits the same world. But I think the difference perhaps this time around is that the feeling of change is the end of a very long cycle of change. And if you do buy into the fourth turning theory, which I think it's a tremendous framework, there are plenty of people that don't buy into it at all. That's fine. But there are plenty of other long cycles, Kondratiev waves and Zeigler and the war cycle. And there are all these long cycle theories. But this change feels different because it feels climactic, and the change, although it's driven by technology, I think underneath that, the change that the older generation like me feel is not a disruptive change that is technological in nature. It's the loss of a foundation and a set of principles, moral and ethical, that were always taken as read, and so it's a longing for a type of country or world, depending on how broad your view is, that not so much functioned in a certain way, but was governed by a certain set of principles. And I think that's the lament for people of my generation, is that we look at social media and we look at the narcissism and we look at all these things that the culture has pushed those younger generations towards, excess consumption and consumerism and peacocking and all this stuff that really wasn't how we grew up. And while no generation grows up the same way as their parents by definition, the nature of this particular change feels inauthentic. It feels cosmetic. It feels hollow. And so I think that's one of the reasons, perhaps, as I've thought it through, why religion is making a comeback, and it is making a comeback. You read articles about this everywhere, and in the midst of this kind of depravity that you see on social media, underneath, bubbling away, is a return to religious beliefs, which is undeniable. So it's a fascinating contradiction, and that's why it's been such an interesting project to journey to go on with Dimitri, because neither of us have any idea where it's going, and every conversation we've had has made me think about something else, and not all of it falls into the way I see the world, and I'm perfectly happy with that, because the way I see the world, I'd be quite pleased if it wasn't the way I saw it, because it unnerves me. So yeah, I just think this is generational change. This is once in a give or take 100 years we get this kind of change, and so the nature of it is a great source of curiosity to me.
Chiseling away at power while at the same time old institutions or old messages call back to us is, I think, really interesting here. And I'm thinking of Sir Stephen and Pitchfork Papers.
Yeah.
Wonderful, wonderful to read. If you're not subscribed, you should check out Sir Stephen's work. It's excellent. I think about something that you really planted in my head. You saw a really major change at the time of the seizing of the Russian SWIFT assets, the banking system. And it feels like that was a really big, strong signal that the global order and the way money moves through the world, all of a sudden, that's a change. That's changed. I don't think have we recovered from that at all? Or is that just, we're still feeling the ripples of that one?
Yeah. I don't think it's the kind of change you can walk back. That's the problem with that particular change. The nature of it is such that it undermines trust. And trust is the foundation of society. The entirety of society is built on trust. Without it, there is no cooperative society. There's no functioning monetary system. There's nothing without trust. And so this was why, to me, as soon as I saw that happened, for anyone that's kind of not up with us on this, back in February, after the Russians went over the border in Ukraine, the Treasury, United States, basically seized Russian central bank assets that were held in the SWIFT system. So they're dollar assets, basically. It's about $300 and change billion. And they froze it. And that, for me, was a dramatic turning point, because, as I said at the time, and I've said since, once that happened, the US Treasury essentially incentivized every central bank in the world to find an alternative to holding their money in the dollar system, which had been completely trusted and completely trustworthy since Bretton Woods, back after World War II. So you've given up essentially 80 years of trust in the way the system works, and the fact that our assets are safe in dollars. No matter what, we will always have access to our assets. And this is a national security issue. And this is why central banks have been buying gold hand over fist, because that's nobody's liability, and it's you can custody it yourself, and it's outside the financial system. So that's a big change. It's not an obvious change to anyone who's outside the monetary system. And in fact, interestingly, Matt, a lot of people inside the monetary system working in finance didn't really see that as such a big deal, and many still don't. And I understand that. That's totally fine, but I feel personally very strongly that was a pivotal moment that has set in motion a set of wheels that will continue to turn until there is profound change in the way the monetary system works. And it may be slow, but it's inexorable, and it's necessary now, because all of these countries now have to find a way to secure their assets, and they know that they can't take the risk that they end up on the wrong side of the US for some reason down the track, and get their assets frozen. So it's a big change.
Specifically with gold, because this sets up a game where you have to own it inside of your borders. You have to own it to understand who your partners are, how they think about it. You've been thinking and writing about gold for a long time too.
I have, yeah. I fool myself with it sometimes.
Yeah. This really did, I look at that moment as significantly changing the argument for why central banks had to own and acquire gold. Is that a fair thing to say? And is there anything that reverses this, or is this just constant pressure that we see for the
I don't think anything reverses it soon. That's not to say that the scramble to buy it won't subside a little bit.
Sure.
The important thing to understand, though, is every ounce of gold that these central banks buy is going to be in their vaults for some considerable amount of time. Yeah, they're not going to buy this and in 6 months go, okay, phew, all clear. Let's dump that again now. That's not going to happen. So you've soaked up a lot of gold out of the market, physical gold that's gone into vaults from whence it's not returning for a long period of time, and you know that they stand ready to buy more. They're going to be sitting on the bid if they get the chance to divest themselves of treasury bonds, for example, and therefore have less reliance on the vagaries of the U.S. Treasury. A lot of these governments are going to do it. There's a lot of noise about the BRICS, and it's a bit of a red herring because these BRICS summits come and go, and in the lead up to them, all the gold bugs say, "Hey, this is it. They're going to announce something this time, and look out, dollars, your days are numbered." And all the naysayers go, "It's never going to happen." Then we have the summit, nothing happens, and all the naysayers go, "See, we told you this isn't going to be the same." And the other guy, "No, next time that." It's all kind of to miss the point. The point is the direction of travel, and that is now clear. These guys are incentivized to find a way to work together. Whether they will or not is really besides the point right now, but that's what they're working towards. So every time they don't manage to do it, it doesn't mean they stop. It means they try harder. They find another way to work together. So they're going to continue down that road until they can either find a way to work or the all clear signal gets sounded. And I just don't see that all clear signal getting sounded anytime soon, given the nature of this bigger change that we've talked about, this cyclical change wherein major institutions get torn down. And, Neil Howe was the first guest we had on the 100-Year Pivot, Dimitri and I. And, I went to interview Neil 2 or 3 times, long, in-depth interviews, and they've been fascinating, every one of them. And we talked about the fourth turning the first time I went to Great Falls to spend the day with him. And we talked about the nature of those fourth turnings, where these institutions that have been central to the way the world functions are, again, coming back to that word trust, are no longer institutions of trust, and they get torn down and replaced with new institutions that people feel they can trust more. And so when Neil came on the podcast to talk about this, we talked about the Treasury, and we talked about Europe, potentially, that institution. We talked about the UN and the WHO after COVID, and all these institutions that suddenly people have no trust in anymore. And Neil said something that kind of shook me to my core and still rattles around my head. And he said, the US Constitution is an institution. And I hadn't thought of it that way, but of course he's right. And so I put that thought that the threat that the US Constitution is under, whether it's kind of glib threats like Trump saying he's going to run for a third term and, he's just kind of yanking people's chains for now, but these ideas that suddenly people are talking about and having to think about, you line that up with Sir Stephen's essay about the end of the nation state as a concept, and we go back to the way the world functioned before. And then there's a great video on YouTube which shows the shifting borders in Europe from the kind of 17th, 18th, 19th centuries. And it was in constant motion. The Austro-Hungarian Empire gone, the Habsburgs gone, all these things that were massive empires, all gone, and borders redrawn and countries reimagined. And so this kind of change is what we're talking about here. This is the kind of change that we haven't experienced in our lifetimes. And it feels, and conceptually, it seems way too big to actually happen. This is ridiculous. I mean, how could the UK become 4 different countries? Never mind Texas or California seceding from the Union over there. But of course, you go back to the 1700s, and of course, Great Britain was 4 different countries. And the fact that we've been through this 200 or 300 year period where they've been joined together, we know the Scots would be out tomorrow if they could find a way to make it work. The Welsh should probably be right behind them, the Irish for sure. So it's really tradition that's holding a lot of these institutions together. And so in a world where institutions are being challenged and institutions are being deemed unfit for purpose, this idea that reimagining them in ways that we haven't thought about, in technology, everyone thinks it's fine. You reimagine things through a technological lens. People go, wow, well, of course we should do that. We should totally rethink everything through a technological lens. Think about it through a societal lens, and suddenly people start to say, well, that will never happen. And it's just an interesting exercise to me to think these things through with the aid of smart people like Sir Stephen and get a sense of, okay, what if, because whatever the chances are, I would have felt very confident saying there was zero chance of any state seceding from the Union, the United States, 10 years ago. I would have said zero chance of the UK breaking up and maybe a 10% chance of Europe breaking up. I don't know what those percentages are now, but they've all gone higher. And it's not a 0% chance of, say, Texas leaving the US. It's just not anyway. Only 1%, but that's a big shift. And, the UK and Europe and, there's a lot happening that's very, very big and very disruptive, and it's difficult to get our heads around. But I think it's important to at least spend time thinking about it.
The idea of the hollowing out, and I think this connects to the technological idea here too, is we've already stepped into this new reality post the Russian banking assets, where I don't want to call it a two-tier system, but that's kind of what we have going on here. We have China, or we have Russia, or we have maybe not Russia, China and others, where you'll engage in the dollar reserve system for certain things that you need to do with the mission to reduce as much involvement you have with that system as possible. Yeah. You want to be there when you need it, but not when you don't need it. That's a different kind of hollowing out that's happening inside of the U.S. dollar reserve status. Do we watch that? How do we worry about it? What do we worry about it? Is there any way to monitor this, or is it just?
Yeah, I don't think it's something to worry about per se right now. It's not something that's going to impact your life tomorrow, or in the next 6 months, or probably in the next year or two. But there are points along the way where that calculation could change because it's now in play. These things are happening. So it is something I think you need to keep an eye on, and you need to keep an open mind on. There's no guarantee as to how it plays out, and maybe something does happen to bring all these countries back together. All these things are on the table now. But whereas I just gave a presentation earlier this month in Florida about change and the nature of change, and I talked about these last 40 years of tailwinds we've had, and the fact that all that has now changed. And I went through bond markets and equity markets and asset prices and house markets, housing prices and interest rates and mortgage rates and all these charts that give you a picture of the financial world over the last 40 years up to 2020, up to COVID. And then, post-COVID, you start charting them from 2020 to 2025. And it's inarguable that things are very different now. And I took a number of polls in the room. There's probably 300 or 400 people in the room, I would think. I walked them very carefully through a set of questions that I wanted to get a sense of. And the first one being, who in the room feels like the world has changed post-COVID? And pretty much every hand went up in the room, which I expected. And it was a bit of luck, actually, because I'd written the rest of my presentation assuming that was going to be the case. But then, I walked through a whole lot of other questions about the way that the monetary system and asset price had functioned over these last 40 years. At the end, I asked people another question. I said, look, given everything I've showed you about the way the last 40 years has been, should it have been, not necessarily was it, but should it have been easy or hard to make money investing? And 95% of the people in the room said it should have been easy, because we've just had this incredible period of falling rates and rising asset prices and stability and growth in trade and populations and lower mortality rates. We had everything going for us for those 40 years. And then I went into the charts since then, showing population declines and trade declines and GDP stagnating and interest rates going up. And just on a simple apples to apples comparison, you say to yourself, well, look, I've just shown you the last 40 years, the backdrop you had and how easy it was to make money. I'm now showing you the last 5. And while those 5 aren't necessarily how it's going to go for the next 35, again, the direction of travel is clear here. Something needs to change materially for this world we have now to go back to how it was. I don't think that's going to happen anytime soon. And so you need to get ready for the fact that it's going to be much harder to make money over the next 40 years. And the things that have worked for you really, really well, like buying the dip, may not work so well. And how do you break reflex actions? How do you have the wherewithal to say, I feel that things have changed, and instead of trusting what's worked for me for 40 years, I'm going to go out on a limb and say that I need to change because I feel something. Let's come back to this whole 100-year pivot thing. I feel things are different. And if things are different, I need to change too. So there's a lot of stuff going on that you need to step back to get a handle on. And the reason it's worth doing that, I think, is that you want to try not to get blindsided, because we can carry on and markets are all-time highs and every day there's a new quasi-trade deal and markets jump again. But if you're just sitting there looking at markets, you run the risk of getting run over if you're not seeing this bigger picture behind you. And I just think it's important, there's a million people offering trade ideas in the moment and ways to put option hedges on to make money and buy this dip and buy that dip. And you don't need another person doing that. But I feel there aren't too many people saying, hey, are you just stepping far enough back to at least consider this? If you spend time thinking about it, you decide, yeah, doesn't matter to me. Great. No problem with that whatsoever. But not considering the fact that things might have changed and things might not only be very different, but much harder. I think, and the point I made in the presentation was that if you had been invested in markets for any point in any meaningful length of the last 40 years, you got rich. Unless you panicked in all the wrong places, and you'd have to have panicked at all of them to be underwater, you got rich. And if things have changed, how do you stay rich? How do you hang on to that and not let the markets take it away from you?
Something that really stuck out to me, and I can't remember, I feel it's been a good while since you introduced this, the buy the dip era is ending or over theme. It's been a good while you've been talking about this, I think, right?
Yeah, a couple of years for sure.
That's okay. Earlier this year, 2025, when we experienced the dip, which did get bought. But I've wondered every time.
Absolutely.
Is this, it feels like every time buy the dip happens, and to the extent that it's become, you can buy a coffee cup or whatever with buy the dip on it now.
Yeah.
The meaning of what is being bought in that dip is, it feels like is getting more and more concerning of, well, of course you just buy this crappy, awful, god-awful, worst meme coin ever, and that's included in what you're buying in the dip. That concerns me for the stay rich thing.
I agree. It's worked, and for the time it continues to work, although the dips have gotten a bit scarier. The dips are slightly different in nature. They don't bounce. Excuse me. They're not bouncing immediately back. The Fed is not riding to the rescue and cutting rates at the first sign of trouble. So, if you look at the outcome, i.e., markets are back at highs, you're perhaps missing again some of the nuance of this. The fact that these dips are very different in nature and much more dangerous. And so, look, you can pick up all kinds of pennies in front of the steamroller, and you can step away long before it gets anywhere near you, like the Austin Powers thing. No. But if you stay too long, you're going to get squashed. And so that is the nature of this change, is that these dips, the Fed are out. Trump's trying to pull them back in. And if you look at what's happening, people are cheering Trump's going to fire Powell and take control of the Fed as if that's a good thing. I mean, it is categorically not a good thing, right? It might be good in the short term for markets. It's not good for confidence in the dollar. It's not good for confidence in US treasuries. It's not good for any of those things. But this short-termism, this idea that don't worry about it next week, let's worry about making money tomorrow. You can say markets are all-time highs, therefore buy the dip is still working. And there is a lot of truth in that. but it's becoming a lot scarier. It's becoming a lot more fraught. And um, if you look at it objectively without focusing on the numbers, the nature of what's happening has definitely shifted. Um, and so, I think this is the interesting part of retail. Retail was always the group that panicked. It was always retail that sold the dip. And the hard-bitten professionals would sit there and wait until things got stupidly oversold and they'd buy it. And now retail is the one buying the dip, or other ones buying the dip. And again, that's a very interesting change. And it's a difficult thing to talk about without sounding like you're denigrating the retail, which I'm not trying to do, because they've made a lot of money buying the dip. But I think a lot of them would perhaps agree that there's not an awful lot of careful strategy and consideration going into what they're doing. They're simply buying the dip, and they're buying it through ETFs. They're buying it through options. They're buying it through as much leverage as they can to add the juice, and it's worked really, really well. But it doesn't necessarily, being right for the wrong reasons is often as dangerous as being wrong. And the hardest thing to get people to do when they make money is to sit back and assess, okay, was I lucky or was I good? And a lot of the times we get lucky, and we confuse that with getting it right. Just because we picked the right stock, our case for owning it might have been a complete load of garbage, but somebody came in and made a big bid for the company, and we think we're superstars. There's not much time for reflection right now because markets are moving so quickly. And so I think a lot of people will buy the dip. They see the number in their Robinhood account go up, and they figure, great, I'm a champion. And I hope that carries on forever. I would love markets to go up forever and everybody to make money. Of course, we know that doesn't happen. And generally speaking, the nature of the big corrections, it has tended to be retail that's been hurt the worst. And while at the moment it feels as though they're actually driving market flows, when things become unhinged, which they will, at some point, the behavior that has worked for them and has been reinforced over these dips is going to be even more damaging to them. Because instead of touching the stove once, they're going to touch the stove when the market falls and think, no, that's not pain I'm feeling. That's because I don't feel pain when I touch the stove. And it's going to take them 4 or 5 touches before they realize that their skin's singed off. At which point, they could have lost who knows how much money. So I want to say it's a time for caution, but I think it's perhaps a better, as soon as you use that word, people go, oh my God, I don't want to be cautious. I need to swing for the fences here. Maybe it's just a time to be more pragmatic about what you do, how you do it, and the results you're getting and why.
So if you're a retailer, if you're any small investor, small relative, meaning you're not a central bank, you're not a multi-billion-dollar strat hedge fund or something like that, how do you think about capital preservation? How do you think about the philosophy of just being not necessarily conservative, but being aware of how you're not going to buy the dip and make a calamitous mistake? Like what's even safe anymore that you can own?
Well, this is the crux of it, Matt. You've hit upon the crux of it. This phrase, capital preservation. It sounds chicken, right? In today's markets, what are you trying to preserve your capital? The subtitle of my presentation was First Principles and the Lost Art of Investing Through Crises. And I went back to talk about the first principles of investing. And I took a straw poll. I went to the internet and I said, give me some first principles of investing. And I listed the things that the internet threw back at me. And they were, diversify and minimize fees. And, I had a list of 7 of them. And, again, let's do this. Hands up anybody who disagrees with that. And pretty much nobody put their hands up. And then I defined what first principles are. The very basic building blocks of something. You can't distill them down anymore. And of course, all of these first principles have become thought of as such over this last 40 years. But then you get down to, I spent hours talking with my friend Tony Deaton about this over the years, this idea of the true first principles of investing. And he wrote an extraordinary memo about this earlier this year, which he very kindly let me share some of to this audience. And you come back to principles like scarcity, the idea that resources and labor and capital are scarce, and trust. Trust is a first principle, and having a low time preference and durability, and these words that have kind of lost a little bit of their meaning over time, but in there somewhere is capital preservation, which is an absolute first principle. You have to preserve your capital. Without it, there is no money to be made. And what's happened is capital preservation. I at the end of it, I use that Drake meme, where he's going like this and doing like that. And capital preservation is very much this, and capital accumulation, right, is what everybody's hungry for. They want to get more capital. And that's great through this 40-year period. I keep coming back to this period you've had. It's been a great time to accumulate capital. But if we're going back to first principles, if the world is changing, then your number one goal is capital preservation. And that is an extraordinarily profound change in how a lot of people need to think about this. Because if you put that first, if you put capital preservation as a first principle of your own portfolio, and you then go through and look at the things you own, most people are going to go, well, if I'm trying to preserve my capital, these 6 times short, double short ETFs, I shouldn't really have those. And, the 0 date to expiry options I've got on Tesla, that's not really capital preservation. So again, revisiting definitions. I started the presentation with a quote from Socrates. The beginning of wisdom is the definition of terms. And so going back and redefining what words mean, simple words that you take for granted and that morph and change over time, is important. And getting back to this idea of, okay, what are the fundamentals here? What do I need to do? And the reality is, even through this period, capital preservation was still your first goal. That's never changed. You've gotten away with not putting it first. But I don't know how long that's going to last. And if you lose your capital, you're out. Game over. So it's a different way of thinking. I was intrigued to see these big whales in Bitcoin. Some of these original Bitcoins, $80 billion odd sold in a couple of trades recently. And I found that very, very interesting, because that's a big, potentially, right? We don't know who sold them, but that's potentially a huge mindset and attitude shift from something that was going to double every 20 minutes for the rest of time to someone saying, I've made $80 billion here. I want to keep it. And I don't believe that leaving it in Bitcoin is how I'm going to keep it. They could be moving it to monkey JPEGs or Ethereum. I don't know. But there's a big change there, saying this asset that I've had the balls to hold on to from a couple of pennies to $100,000, I'm now selling. That's a mindset shift. And I think the more you look, the more you'll see those. You'll see it not just in financial markets, you'll see it in European politicians coming to the table to deal with Trump, having laughed at him in 2016 when he went over there and told him all the things he would do with NATO and all that stuff. You'll see it in attitudes to pronouns, right? People are revisiting that and changing the way they think about that. You see it in this American Eagle advertising campaign with Sydney Sweeney this week, right? Suddenly sex sells again. And let's be honest, sex always sells. It's just been kind of on the nose a little bit for the last few years. But that's changing. So everywhere you look, and it's not easy sometimes to equate things and bring them all back to markets or money or anything else. But this idea of change, real change, in not just markets or the way central banks think or the way markets are functioning, but the way societies think and the way societies act with each other and with other societies, all of that stuff is changing. And we all feel it in different ways. But how do you not brush it off and at least devote some time to thinking about, is this something important? Because to me and Dimitri and all the people that have listened to this podcast and sent us some amazing emails, it does feel important enough to be worthy of spending some time considering.
It feels like there's the shift at the national and the larger levels and then the local level. And that's part of where this connection for finding what's important matters. And whether you're an individual investor and solving it for your portfolio, it forces the question. The zero DTE Tesla options or whatever you're trading, all of a sudden when you have to think about what do I do with this in my, when I say local, it might be my national economy, but I have to think about what assets do I have in the system that I am living and operating in. And that's very different in a deglobalized world than a globalized world.
Amen. Yeah. And our mutual friend Ben Hunt has been ahead of this for a long time, right? I mean, the idea of the pack, the Epsilon theory pack, and this idea of going small and going local and building communities from the ground up. Again, that's a fundamental change. But Ben was early with it. And so people didn't fold that into anything bigger. That was just, Ben's doing something interesting or something new with Epsilon theory. But it's all part of this. No one is more acutely tuned into this stuff than Ben. I mean, nobody. And the fact that he's been ahead of this was just a great signpost for people if they were paying attention. And I think that you see that rippling through all kinds of things, whether it's on a local community basis or a statewide basis in the US or a national basis. It's happening. And the sooner people recognize it, and as I say, you don't have to change what you do. You don't have to change how you interact with it. But I think it's sensible to think about it and to think about the nature of change. And if this change is real, is it going to impact you negatively? And for many people, given how positive everything has been for such a long time, if there is change, it is more likely than not, things aren't going to get even better. They're going to change for the worse, and you need to change the way you handle things.
I want to go back to this, the Bitcoin whales and some of the liquidations and the things that we're seeing. Yeah. Depending, and the things that we don't know, but I'm asking you to speculate on purpose with some of this. Somebody who's got a massive position in something, and whether it's a massive position in gold, or you're a country and you have a massive position in treasuries, or you have anybody who knows, I have too much of this thing. What's kind of the steps you would advise, consult them to walk through on, you have too much of something, what do you do about it?
Look, it's like alcoholism, right? The first thing is recognizing the problem and admitting it. I mean, that's the truth. Because for years, the narrative was you couldn't have too much Bitcoin. It's impossible. Right? And Michael Staylor still buys into that. You cannot have too much Bitcoin. You should mortgage your house and sell your kidneys for Bitcoin. Some of these original whales obviously have a different view now. And that, because making money has been, quote unquote, so easy, and I don't mean in the day to day, but I mean, as I say, if you look back, as that show of hands showed, everybody should have made money, right? And because that's been so easy, you assume it's going to continue to be easy. So the idea that you could have too much of anything is a difficult one to get your head around because it's all worked. So how can you have too much of something that keeps going up? You can't, right? And so it generally tends to be the people who are willing to be wrong for a little while. Stan Druckenmiller and Paul Tudor Jones and all these great traders, they all talk about the belly of the trade. They all talk about leaving the first 10, 20%, the last 10, 20%, and taking that 60 in the middle, 60 to 80 in the middle, and just riding that and taking as much as they can out of it, leave some on the table at both ends, and you're never going to get in that real trouble that you get when you're long at the very top or short at the very bottom. Um, but it takes a lot to do that, and it takes even more to do it in a period where the opportunity cost of being wrong seems so enormous because markets just keep going up. And because of this buy the dip thing, the idea that, well, why would I leave money on the table? Because even if I'm wrong, it's going to bounce back. It shifts the way people think about things. And it's only the Druckenmillers of the world and the Tudor Jones of the world who have that ability to say, you know, I'm happy, I'm comfortable, I've made my money, I may miss the rest. You know, Druckenmiller tells a terrific story. My favorite story that I ever heard him tell. He was being interviewed by Ken Langone live on stage at the Lone Pine Tree Club dinner in New York. And Langone and he are old friends, and so they could talk, you know, as old friends. And Langone asked about that famous story in the dot-com bubble when he blew $1 billion of Soros's money because he called it a bubble, and he sat out and he had these 3 or 4 young kids making a fortune every day, just whooping and wailing. And he in the end, he said, I cannot stand this anymore. And he piled in and blew $1 billion in a matter of months. And Langone said to me, you know, what did you learn from that? And Druckenmiller's answer was just brilliant. He said, I didn't learn anything from it. I knew I shouldn't have done it in the first place. I just couldn't help myself. And that, I've always found that very profound, that even Stan knew he shouldn't have done it, but even he couldn't resist that temptation at some point. So it gets all of us. If it can get Stan, it can get you and me and every single guy out there that's a hero because he's made a ton of money on options. So the first thing is being comfortable with this idea that I've made money and protecting it is now as important as making more, perhaps more so. So how do you protect money? Well, you take it out of harm's way. You know, you don't have to put it in treasuries, put it in gold, put it in something that's safer than being in highly levered, short-term, volatile instruments. And sit for a while. And if things calm down and this feeling of change goes away and we all join hands and sing Kumbaya and, you know, Russia and Ukraine get along and India and Pakistan and China all get along and the world becomes a great, you know, like a Coca-Cola advert, the new seekers, hell, pile back into the markets. But for the time being, just recognize things have changed. And so a different approach from being all in is having some money on the sidelines that can't hurt you if you are wrong suddenly. You know, there's so many quotes in Wall Street, and everybody always zooms in on the Gordon Gekko quotes. You know, if you want to
Greed
friend
is
get
good
a
and
dog,
all that.
greed is
Yeah,
good,
yeah.
all that stuff, right? We all know those quotes off by heart. The best line in that film is Daryl Hannah saying to Charlie Sheen, you know, saying to Bud Fox, she says, you know, having money and losing it is worse than never having had it at all. And that, to me, is the real takeaway from Wall Street, right? If you're lucky enough to make money in these markets, and a lot of it is luck, right? There are a lot more lucky people than there are smart people, because the smart people, we all know their names. And they're the Bruce Coffins of the world, and the Druckenmillers of the world, and these guys that make 20, 30, 40, 50, 60% compounding every year for 20 years, right? We know their names. There are a lot more lucky people out there. And so if you were lucky enough to make money, don't lose it. Just don't lose it.
My brain keeps going back from when we talked about that wonderful series that you did with the 5 essays. And I keep going back to Roger Mitchell and what he had to say about this. And a running theme in his book, and Sports Perfect Storm, which excellent read, and all the work he does with Alvacara. Not just figuring out ways now more than ever to invest in those community assets, to understand what those are, and not just the personal enrichment, and making sure you have a strategy for, you know, re-diversifying. So you hit it big. You had a great win. You had something work out. How do you reinvest in some community asset? And I think he draws that parallel well with the resurgence of interest in religions. But how do you think that? What's the broader extension besides just financial capital that people could think about?
It's difficult, Matt, because people have become so used to investing with the aim of returns, financial returns, of compounding their capital and beating the benchmark and beating their friends and all that stuff. That's become the reason for investing now. It hasn't been investing in community assets for a long time, and even a lot of the money that's come into Roger's world, the sports world, where these things are community assets. Liverpool Football Club, owned by the Fairway Sports Group, is a community asset first and foremost, but it's not been treated like one by the Fairway Sports Group. It's a bridgehead into a world where they think they can make a shit ton of money, frankly. And they've done a great job. But ultimately that is a community asset. And so actually what's happened is a lot of community assets have been sucked into the financial world, and because they're community assets and that community connection is deep and strong, they are seen as great ways to make money because of that deep, strong connection, right? These people are loyal. They would spend their last dollar getting a ticket to get into Anfield to watch Liverpool Everton or Liverpool Man United. And these are great customers to have, right? So again, we may see that reverse in that, not that people won't invest in sporting assets, particularly as a means to make money, but if hard times fall and the fans can't afford to go to the games, watch how quickly they turn on the Fenway Sports Group. They won't care that you won the Premier League for them twice in the last 4 years. First time in 40 years they've won it. They won't care about that anymore. They just want the prices lower. They just want to be able to see their team. And Jim Pilotta is a friend of mine, and he was a part owner of the Boston Celtics, and he and a group bought AS Roma in Rome. And I remember having dinner with Jim when he was going through the process of buying it. And he said to me, Grant, this could be my greatest deal ever. He said, this is Rome. He said, it's not Manchester City or Chelsea. This is Rome. It's actually the name of the city. This is great branding. It's going to be phenomenal. I'm so psyched by this. And I remember saying to him, I said, yeah, but Jim, the football clubs, they're largely vanity assets. And is this a really smart business move, or is this something that you really fancy doing? No, this is going to be a great piece of business. And I'll never forget, 2 years after we bought it, I was talking to a mutual friend of ours. And I said, how's Jim getting on with Roma? He said, don't mention Roma. Whatever you do, just don't mention Roma to him. And the reason being, the team were doing so poorly, he basically couldn't go out in Rome without being abused. And, it didn't matter that he brought all this money into the club and they bought all these players. That didn't matter. The team were losing and he was persona non grata. The following year, they caught lightning in a bottle and were at the top of the Scudetto, and they got into the semi-finals of the Champions League, and Jim couldn't go out in Rome without being carried shoulder high and couldn't buy a drink or a meal in town, right? And so those are the two signs of the true community assets, right? And Roger's analogy for it is so perfect. He said that, the owner's basically, right, just leave your credit card behind the bar. And when we've maxed out your card, we need someone else to come in with their credit card. We're done with you, out you go. So the nature of community assets is going to be a really interesting thing to see how that shakes out, because they have been tremendous ways to make great profits for astute investors. But again, I suspect that's going to change, because the costs now to the fan is approaching that level where it becomes an issue, and you take that away, you take a community asset away from the members of the community who value it as their church on a Saturday afternoon at 3:00, and you'll have problems much quicker than you would get from investors.
I'm giving you a variation on a closing question on the spot, so no pressure. You know how it goes. A lot of your peers that you're talking about in this 100-year pivot series would agree with you that something is afoot. Nobody can really quite agree on what is afoot or how it's going to play out or where this is going to go. Is there anything that you see? Give me the Grant Williams reason for optimism on, even if you can't predict what the outcome is, that works this out. Why do you not just go, forget it all, put me on a rocket to Mars, and I'm out?
I think there are two causes for great optimism. One is a quote from my friend Steve Diggle, who says, at the end of the day, we are clever little apes and we figure things out. And he's absolutely right. I mean, look around you. And the other is the very nature of the change we're talking about is cyclical. These are big, long cycles. And we just happen to be going through the kind of shitty part at the bottom of the cycle when it breaks. So everything that follows, if let's just use Neil and Bill's framework, fourth turning, as a framework just for this part of the discussion. They talk about 20 to 25 year turnings, right? So a 100-year cycle. We're in the bottom 25-year part of it. And if they're right, and it began in 2008, we're closer to the end than we are the beginning. And while that means, because these things are climactic, that things are going to get worse, not better from here, what it means is when we get through it, and we will, look at what mankind's gotten through so far. We got through the plague, and if you lived in Europe, the chance of you not being at war with someone was zero for about 200 years. We will get through it. And then you have 60, 70, 80 years of upward trending society, progress, all the things that we're seeing ripped away from us now that we'd come to expect will come back and be built up by a new generation that will build them in their own way and in their own image and the way they want it to. And that would be tremendously exciting. I'm out in the middle of all my grandkids this week, and while I lament the world that we're leaving them now, I'm pretty sure that by the time my grandkids, who are 6 and 4, by the time they're 26 and 24, it's going to be a very exciting world for them. My poor daughter's screwed, but that'll teach her to keep me awake all those nights. But this idea there's no hope for optimism, there's no opportunity for optimism, I think is massively misplaced. It's dark now, but it's darkest before the dawn. So there is reason for optimism. The trick is to hang on to whatever you can now through this period. All the stuff you've made, hang on to as much of it as you possibly can, so you're able to deploy it at a time when you can actually invest your capital and you don't have to watch every tick of the market. You can invest your capital in assets that you can just say, right, I'm done here. I've put all my money into this, and this. That's me for the rest of my life. I'll leave it to my kids. It's going to be fine. I've bought them at great valuations. These are solid companies. I don't need to worry about the markets day to day. And that opportunity will come again. It will absolutely come again. We've just got to get through this part first.
No better reason to preserve some capital and survive than that. Right? Grant,
I'm preserving all my capital for ice creams tomorrow. I've been suckered into a yes day for my grandkids, so I've got to say yes to everything tomorrow, which is going to be an interesting proposition.
I mean, if there was a religion that I was in for, it's for the Grant Williams yes day and all the treats that come with it. Grant, people want to bug you on the internet. They want to find you. Where are you hanging out these days? Where can they follow along with the 100-year pivot work with you and Dimitri?
Very simple, grant-williams.com. It's all there. It's all on there. And Dimitri's hiddenforces.io. You can listen to it at either place. So whichever one of us annoys you the least, listen to it there. Will be my. You'll hear the same audio, but at least you haven't got to look at the same face.
It's a fantastic thing. It's always good to see your face. Remember, we can say cheers to mortgaging the house and Bitcoin and everything else, as long as we haven't sold our liver. Sell the liver.
There you go.
It's all downhill from there.
There you go.
Grant's lovely.
All right, my man. Matt, as always, thank you, mate. I appreciate it.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.